Hi, I'm Kevin Ryan, a partner at Citrin Cooperman and working in the manufacturing and distribution group. And I am speaking today with Jaime Reichardt, who is also a partner in the firm and does a lot of work in the M&D group and is in our SALT department. Now, Jaime, for the people that are not pool accountants like us, can you tell us what that SALT acronym really stands for and what it is you do?
Oh, absolutely. Thanks, Kevin. SALT is the acronym that we dorks refer to as state and local tax. And, my role at the firm is, as a partner and SALT partner for national tax. I help clients navigate the maze of state and local taxes across the country. And I specialize, consulting, compliance, controversy issues, and potentially helping to structure and help clients save money on their taxes as well.
Thank you. Many manufacturing and distribution companies have heard the terms Wayfair and Nexus. They don't always know what they mean, but they believe that it means they may have an income tax compliance issue or a sales tax compliance issue. And obviously it has changed significantly over the last few years. Can you give us some insight there?
Absolutely. And it's a good question because it comes up in our world constantly. And effectively what it refers to as Nexus is the concept that essentially means when a state can force a retailer, a company that makes retail sales, to collect sales tax when it comes to sales tax purposes. And from an income tax perspective, Nexus refers to the idea of when a state can force a company to file an income tax return and have to report income that's taxable to the state of reporting. And, the difference between the two, and one of the major concepts that's really been a protection, I would say, for the manufacturing and distribution space, is a concept that we refer to as PL 86272, Public Law 86272. That is a federal law that was passed several decades ago that essentially says when a company limits its activities to making sales of tangible personal property, like physical goods, into a state, and that's its only activity, plus some marketing and sales activities, the company doesn't have to file an income tax return, is not going to be subject to a net income tax. So the interesting phenomenon that has occurred in the last number of years is that over the last 4 years, essentially, sales tax companies are being forced to collect sales tax and report if they generally make $100,000 of retail sales into a state. Some states that threshold goes up to closer to 500,000, but in general, 100,000. Whereas on the income tax side, again, when the company files its income tax return, it's protected from having a filing requirement, or in some cases having to pay income tax, because of this Public Law 86272 protection. So it's an interesting sort of dynamic that we're seeing where having to file and pay all these states for sales tax, but having this protection under PL 86272 for net income tax purposes.
So they don't go hand in hand, right? You may end up having to file in a multitude of states for sales tax purposes, but not necessarily for income tax purposes. And there is a distinction there. Thank you. I'm sure your job and your role and the work that you has changed over the last few years and continues to evolve. How is what you're doing now different than what you did a few years ago?
Sure. So I would say sort of the two, phenomena that are sort of changing the SALT landscape, and, one of which has been changing over the last, I would say, decade or more, and then another sort of dynamic, which is more recent. The older sort of dynamic, I would say, is as we are continuing to evolve into a digital economy, right, with things going on online, services being provided digitally, electronically, et cetera, there's been this notion of sort of, does public law, that 86272 protection, does it change in our new economy? And I'll explain what that means in a moment. And then the other sort of phenomena is remote work, right? People now are working from all over the place. Employees are all over the place, even if they're not involved in the manufacturing process. Maybe they're involved in supplying, maybe they look for goods, maybe they help identify relationships with vendors, negotiate, do all sorts of activities for the company. If they're doing it from all over the country, that can potentially create nexus, again, from a sales tax perspective, if the company makes retail sales, and it can create nexus from an income tax perspective as well, in terms of having to file. So I would say the two sort of dynamics that are coming into play a lot is one, again, with the digital economy and things shifting towards electronic more and more, Public Law 86272 in a lot of states is being revisited. And they're saying, well, if you kind of make advertising like over the internet, or you have like email marketing, things like that, and different what we call like cookies, right? So when a company, you go on a website and they're able to sort of have access to your computer, or they store their data on your system, and that's how they deliver marketing, that can potentially trip up 86272 and make it all go away. So with this digital advertising more and more, it's potentially chipping away at 86272, causing companies to have to file in more states, combined with remote employees all over the place having to file everywhere. Mm-hmm. It's really just causing a compliance nightmare and sort of having to force us to give a lot of what we call sort of the technical answer, right, and the legal answer and how it all works, and then help guide from the practical perspective in terms of, okay, here's what the letter of the law says, but then here's how we can navigate this from a reasonable perspective and sort of keeping in mind costs, regular business activities, not turning the SALT compliance function into a new job in of itself.
So another area that is worthy of discussion is tax planning. It used to be you may be filed in one state. So when you did your federal tax planning, the state tax planning kind of went hand in hand with it. Now, that is not the case for many businesses. There is state taxes, which are considerable, and there are local taxes also, not just the federal. So what are some potential areas for tax planning when it comes to the state and local taxes?
Sure. I'll hit upon sort of two major ones, and one being a more recent phenomenon that's really been a lot of the talk in the SALT community for the last, I would say, 3 years, which is the concept of elective pass-through entity taxation. And what that effectively means is, in the state and local tax world, right, if your company is not organized as a C corporation, and by the way, not just, from a state and local tax world, but from a federal tax perspective as well, if the company is not organized as a C corporation, it generally does not pay an entity level tax, right? C corporations pay federal income tax, partnerships, limited liability companies, S corporations. In general, the income flows through to the owners and they pay personal income taxes. When the Tax Cuts and Jobs Act passed back at the end of 2017, it made a very significant change in the personal income tax world at the federal level. It put a cap on the amount that individuals can deduct for state and local taxes. So in the past, there was no cap. So, individuals deducted their property taxes, personal income taxes they paid from businesses, from earning wages, whatever their taxes were, they deducted them. When that tax law changed, again, going into play at the end of 2017 for tax years 2018 through 2026, it essentially put a cap of $10,000 on the SALT deduction. And so what states did to try to deal with that and rectify that is they came up with the idea of elective pass-through entity taxation, meaning pass-through entities, again, partnerships, LLCs, S corps, can elect to pay tax at the entity level, right, to those states, report and pay at the entity level, and the individuals usually either get a credit that they apply on their individual return in that state or don't even have to file in that state, depending on the jurisdiction. And what that accomplishes is that it allows the tax to be paid at the entity level, which means it's not capped for federal purposes because that $10,000 cap only applies to individual taxpayers, not businesses. So when businesses, right, file their returns, whether it's a 1065 for a partnership, the 1120S for an S corp, they can take a full deduction for those pass-through entity taxes that they elected into those states and not get capped at that $10,000 amount. So that's one of the areas that's been really hot from a tax planning perspective in our world, because again, it's creating a significant benefit for businesses that earn a significant amount of income to be able to get the full deduction essentially at the federal level. Obviously, there's different complications in terms of how those taxes are computed, how the credits work in terms of how residents get taxed, how non-residents get taxed, and the different tax bases for those pass-through entity taxes, which we help clients navigate all the time. But that's been the one really hot area because, again, It affects everyone from a federal perspective, that $10,000 cap. So this is something that more than 36 states have put into play to try to deal with that and give a little bit of savings to business owners that own pass-through entities. The other area I would say that's really hot from a tax planning perspective, or that's at least helpful, is when it comes to transaction planning, right? So a lot of the time, federal tax is going to dictate the form of the transaction, but in certain times, in certain cases, depending on the jurisdiction we're dealing with, there may be advantageous ways to structure a transaction, whether it's an asset sale or whether it's an entity interest sale, selling a partnership interest, or S Corp stock. There may be different ways to source the income, allocate the income in a favorable way from a state and local perspective. And tied to the PTE tax, that elective pass-through entity tax, is if we structure, right, a transaction the right way, it could potentially allow that deal to be subject to the pass-through entity tax that we just talked about and get the owners, a 37% essential federal tax benefit for that deduction, taking those, state taxes into account.
So what I take from that is proactive planning could really save significant dollars.
Absolutely. Proactive planning, even sometimes to the extent of creating entities just to serve as almost holding entities, depending on the structure of a transaction, so that we have a pass-through entity to sell something to be subject to the pass-through entity tax. So definitely future planning. And then I would say tied to it, Kevin and I regularly get involved with a lot of not just M&D companies, but all the companies we deal with when they're dealing with the sale of a business, whether it's an entity sale or an asset sale, right? The diligence, right? And so, what I mean by diligence is they'll ask for tax returns, they'll ask for tax payments, records of payroll taxes, all these different things that the other side is going to ask for a selling entity. We'll get involved in sort of on the front end and identify where there may be issues, where there may be liabilities, and how to rectify them so that the deal can go through smoothly. Also, on the other end, from a buy-side perspective, right, if we have a prospective sale to look at, we'll ask for those items, do the diligence in advance. And, although it's not as tax planning, it does represent a savings in that if done correctly, it usually results in savings down the road of not having to unwind transactions, unwind filings, having to redo filings. Kevin, we have tons of clients that we've had to undo payroll filings and state registrations all the time, and that really having the right diligence in place helps rectify that and helps sort of cut that off on the front end.
And I would also say, Jaime, knowing what we've seen in different deals, there's almost a comfort level when on the diligence list, it asked about a Nexus study and being able to supply one, right? Absolutely. So that's always helpful to the business owner, having that study done so they have an understanding of whether or not they're compliant. Since we're really in the M&D industry, can you drill down? Is there something that you're seeing in that industry that would be helpful for tax planning?
Sure. So again, number one thing I'll hit home is that pass-through entity tax, because that's a big one that really every pass-through entity can pretty much benefit from, the owners. Another area that I'll hit home is sales tax exemptions. A lot of folks, in the M&D space, right, we're used to manufacturing equipment, packaging equipment, having exemptions. But a lot of the time, based on state guidance, a lot of companies, when I say companies, I mean vendors of these pieces of equipment and different supplies, will be fairly conservative in terms of their application of the law and sort of how broad those exemptions can be. And often it's a worthwhile exercise to sort of take a look at the company's purchases, whether it's things that are going into the component for item that's going to be manufactured, catalysts, even different types of packaging equipment, packaging supplies, different items to be sort of utilized, whether it's in the manufacturing or distribution space, to see if there's a potential sales tax exemption available. Because that's, again, something where most companies from the vendor perspective, they're going to be more conservative because they don't want to have a sales tax issue if they get audited and having to pay a cost that's not really theirs. And so one of the things I think, Kevin and I, you and I were talking about this last week, was where we get involved in what we call reverse sales tax audits, right? looking at the company's purchases, looking at the invoices, looking at the transaction statements, and seeing if we think we can identify potential savings for the company in the form of, again, looking at the different exemptions, even different sourcing, right? When I say sourcing, is where the product or service is sort of,
Right.
we'll say, recorded from a state purpose, whether it's for sales tax or income tax. There's different ways in which that could potentially be in favor of a company that's purchasing. So I'll give you a real world example, and something that comes up often in the sales tax context. Let's say we have a company that's purchasing software, right? Let's say the software is used in the manufacturing process, or let's say we have a piece of software that's utilized as keeping track of where goods are, or suppliers, or where our people are, payroll software, whatever the software is doing as part of our business. Software is an area where a lot of states impose sales tax, but a lot of the time, right, we talked about remote work and people all over, there's often sales tax licenses that are utilized across the country, right? So a bill may say that the software license is going to Pennsylvania. That's our state, right? So it's going to Pennsylvania. That's where the company's home base is. But maybe it has locations in several states or employees in several states that are utilizing those licenses. And those states maybe don't impose tax on software, don't impose tax on SaaS, or have a different sourcing rule. You may be able to take advantage of sourcing it to a jurisdiction where there shouldn't be tax. What we call that in the sales tax software world is multiple points of use. That can result in significant sales tax savings for companies that are purchasing software, where again, it may be utilized in different parts of the country or by different people in several states. There's an opportunity to save money there. Tied to the software piece in manufacturing, a lot of folks don't realize that you can take an exemption from sales tax in the manufacturing context for software used in manufacturing. And I'll add to that, in the sales tax world, software is often synonymous with SaaS. So even where it's not a license, but you're purchasing SaaS, that's generally considered software, which is usually considered tangible property that's eligible for a manufacturing exemption if it's utilized in the manufacturing process. So those are sort of areas in the sales tax world that a lot of people don't think about, where there's really opportunities for potential savings.
We know sometimes through growth, companies get behind in their compliance issues. We see as we bring in some new clients, one of the things we do is look at their Nexus, right, or the issues, and see if they are up to date from a compliance perspective. What are some of the issues that you're seeing or hearing about out there, and how costly are they?
So, I would say in the M&D space, one of the, major, what we call footfalls or problem areas from a SALT compliance perspective or filing perspective would include where we have scenarios, two common scenarios. One where we have, 3PL providers, right? So let's say we have goods going to a distribution center that may be controlled or operated by a third party. And then those goods maybe temporarily stay, whether it's for a couple of hours, a couple of days, a couple of weeks, and then they go somewhere else. There is the potential and sort of issues for figuring out, one, how to source those sales properly from a sales tax perspective, in terms of, does it go to this distribution center? Does it go to the ultimate retail location? And maybe it goes from the distribution center or some other answer. Another concept that comes up in this space is figuring out if there's going to be exemption certificates, right? So a lot of the time in the M&D space, right, a manufacturer is making a sale to another that's going to, a distributor, right, that's going to resell the product. And again, in these scenarios where you've got distribution centers all over the place and they're, goods are going from one to another to ultimate retail locations, figuring out which exemption certificate to provide the manufacturer so that there's no sales tax charge. Because a lot of the time, again, taking the conservative view, the manufacturer or the vendor is going to say, unless you give me exactly what I need that's under the letter of the law from an exemption certificate in the right state, I have to charge you sales tax. And so those are, again, one of the common areas that come up that bring up compliance issues. Another one is drop shipments, right? So we have a company, right? Let's say manufacturer A, and supplier B, we'll call it. And supplier B makes goods for for manufacturer C. So supplier B orders from manufacturer A, and they tell manufacturer A, deliver it directly to supplier B or supplier C or whoever else, right? A drop shipping, where an order is placed, and the customer, again, the direct customer of placing that order, essentially gives the instruction to deliver that item or that good to its customer directly. All the same issues that I just said in terms of figuring out the appropriate sourcing from an income tax perspective, from a sales tax perspective, as well as which exemption certificate to apply. That brings up nightmares in the M&D space. And we get tons of questions constantly from all of our clients, right? Where again, they're dealing with a vendor and they're saying, we're going to charge you sales tax unless you get us what I need, right? And maybe some of our clients tied to the Nexus issue are not registered in all these states, right? Because maybe they haven't been selling enough into these states. Maybe they just started selling into these states. This is a new world for them. And so the companies are saying, you're not registered. You can't give us an exemption certificate. We're going to have to charge you sales tax. So those are really some of the significant areas from a sales tax perspective and from an income tax perspective, because we have to figure out from an income tax world, right, how we source product. And there's a lot of case law and a lot of guidance in different jurisdictions where you have the scenario like I brought up earlier, where it goes to a distribution center and then maybe it goes to a retail location very shortly after. Some states will say that revenue goes to the distribution center, and some states will say the revenue goes to the ultimate retail location. And having to navigate that and figuring out the sort of mix match of rules and how they interplay is a challenge that comes up fairly regularly in this space.
Yeah, I know you can talk about this for hours. What we find, though, is that even if a Nexus study was done 18 months ago, it's probably somewhat outdated, right? Because these laws continue to change. And even if the business has a good state and local tax person or group, it's important to continue to be proactive and have an understanding, or at least the knowledge that we need to look into this. And we need to talk to people who do this day in, day out, all the time.
Absolutely. I mean, part of my job is talking to people in the firm, talking to clients. And what I say is, I don't expect after our conversation or after an interview like this, you're going to recite for me the Nexus rules and sourcing rules and all the things we talked about. But the idea is to alert people as to when to get us involved, when to ask us to look into it, so that, again, we don't have any issues going forward that's going to hold up a deal, hold up a return, have a lien, being filed against some of our clients and their owners. And so those are all the issues we try to avoid by having these conversations on the front end.
Okay, so let's kind of play that example out. Client or new client, we find that they haven't been compliant. What the heck do we do now, right? You want to be proactive and conquer this issue. How do you do that?
Usually in these scenarios, and again, where there's usually a significant dollar amount tied to it, because often, many times, again, we have to sort of, navigate that balance of providing the guidance under the letter of the law, but providing practical guidance, right? Where we're not telling a company maybe that's been a net loss position for 3 years that they have to go file income tax return in 35 states for the last 3 years. But where there's maybe a potential real compliance cost, liability, penalties, etc. 2 areas that we regularly recommend. One would be something what we call a voluntary disclosure, which is the process by which we submit an anonymous fact pattern to the state describing the activities, how long they've been taking place in the state, with an estimate of what the potential tax liabilities are. And generally, the state will then review it. They send you some additional correspondence. And if they sign off, you'll get what's called a voluntary disclosure agreement, which allows the company to comply, provide all of its information, and it'll limit the look back period so that, in a state and local tax world where one doesn't file, the state could potentially go back to the beginning of business activity in that state. The benefit of a voluntary disclosure is that it'll limit that look back period, usually anywhere from 4 years to, in some states, it's like 6 years, I think the max, and it'll cut off the penalties. So that's helpful from a compliance perspective of sort of getting the company into compliance, advising them of where they have to file, but then saying, okay, here's how to fix it so that we can knock out those penalties, give you a clean bill of health, and you don't have to worry about the past going forward. The other alternative is in some states, depending on the timing and what's going on with their revenue cycle, they may offer general tax amnesties. So we monitor that across the country and seeing, oh, state of Pennsylvania or state of New Jersey or state of New York is offering a fairly advantageous tax amnesty program, which may actually be more favorable than the voluntary disclosure. We will help our clients go through that process and take advantage of that. So usually more often than not, there's a voluntary disclosure possibility, an amnesty possibility, or what we call generally sort of a closing agreement request, where similar to a voluntary disclosure, we'll come forward, we'll anonymously give the facts. And if the state doesn't have the ability for whatever reason, maybe in its rules, to do a formal voluntary disclosure, they'll effectively do the same thing in a closing agreement or a taxpayer agreement to settle tax years and allow taxpayers to continue going forward.
Since we're discussing the M&D industry, manufacturing, inventory is such an integral part of the business. And, I don't know that it's all because of COVID or it just became more prevalent during COVID. It was tough to get inventory. Costs were excessive. Logistics were a nightmare. It seems that more and more businesses are reshoring their plants, and the states are going to fight over them, right? To try to get a new manufacturing employer in their state or in their locale. Credits and incentives. What's going on in that world, or at least in the Mid-Atlantic region here?
Yeah, so there've been, as you've mentioned, kind of tied to what's been happening a lot at the federal level, there's been efforts at the state level to try to capture that economic development that's coming back to the United States and manufacturing activity. So many states have revamped, renewed some of their incentive programs, or even have tied to federal. And when we say incentives, what we mean is it can be in the form of a tax credit, right, that can be utilized against the company's tax liability. You can have transferable tax credits where maybe the company can't use the credit because it doesn't generate enough income. It can sell the tax credit. We have sales tax exemptions, right, where the company maybe have to pay a significant amount of sales and use tax, and there'll be different exemptions available that will allow the company to not pay it. There's property tax abatements that allow the company to freeze the value of the property. If they're doing major improvements, it'll freeze it to the improvement level. Even workforce training grants, right? If a company is going to be doing some customized training and bringing in some new training development opportunities, states will often provide dollars for that. So it could be grants, tax credits, exemptions, refundable credits, transferable credits. There's a whole slew of potential available things. And I think the misconception out there is that a lot of folks think, oh, you need to have, the next Amazon or Apple or, very large company project. And a lot of these states bringing in jobs maybe of 15 to 25 and making a capital investment of a couple of $1 million on a new facility, or maybe rehabbing or bringing in new equipment, you could potentially qualify, and the company can potentially qualify. So states like New Jersey have re-upped their incentive programs in the last 2 years and revamped them to try to capture that. Maryland is another example of they've lowered their thresholds to try to capture some of the small business activity and giving under their One Maryland tax credit. New York has a host of different incentives under Excelsior, as well as a manufacturing tax rate. So New York actually has a specific special tax rate that applies to manufacturers that can qualify. So there's a slew of different things that are available for companies, even that are just doing routine CapEx or that may be looking at a new facility. And the key is, common theme we'll talk about, early planning. When you're looking at those locations and you're doing the analysis and thinking about whether going to state A or state B, incentives shouldn't be the driver, but I always say should be the icing on top. So we can help with that analysis and looking at what the tax profile is going to look like, what the company's financials look like, what the tax cost will be of going to that jurisdiction. And then again, the final piece is layering in what we think the incentives will be, providing an estimate of that, and then going to the state and actually negotiating to try to get those benefits or file for those benefits so the company can capitalize.
And that's something that we can help with the negotiating part of
Absolutely.
that. Right? Okay, thank you. Thank you, Jaime, for your time and for educating me on all these opportunities that are out there. Have a great day.
Thanks, Ken.